Hey gang, welcome back. It's May 4 already. Tomorrow will be Cinco de Mayo. I hope that we have a chance to celebrate it. Typically, here around the Illinois State Capitol, we have a large celebration going on with the Hispanic lawmakers throwing a Cinco de Mayo party. I don't know if it's happening this year. It did not happen last year, but it's one of the great parties of the year. And it's just one more way that this year is still, we're influenced by the COVID pandemic, not just here, but of course around the country. But there's good news. The state of Illinois is opening up more than it has. It's been one of these states that's been very closed over the last year, more so than other states. But even Illinois is now starting to reopen. In fact, the governor here today announced that they were going to have the car convention, car show in Chicago going back in again. So there's good news on the way on the economy. Today we had an overall sell-off in the economy, unfortunately. It was a red across the board with the S&P down about 0.67%. The NASDAQ was down 1.8%, and the Russell 2000 down 1.28%. The Dow eked out a bare profit. We had oil prices going up, I believe, let's see, yes, 2.6%. So we're going to have to watch that. The DIG that I had recommended, that's a leveraged ETF on oil and gas. DIG 127. It's been stagnant for about the better part of the last month. You can see kind of bouncing around. Here's the last 5 trading days. And there you go. I know a lot of people aren't necessarily interested in DIG. What they are interested in is Humble. And the thing I would say on Humble, as everyone knows, Humble is going to be sitting, I think, kind of treading water. It might go up if we get a bounce in the overall markets this week, but I think we're just waiting for Friday afternoon, and Friday afternoon when that comes. I have had a number of emails from viewers, and you can email me here if you want with a question. Sometimes I don't know exactly the answers, so if I haven't gotten back to you, there's some good questions, and sometimes there's questions to things that I hadn't actually even necessarily thought about. So I want to take a little time to kind of reflect on that and not pass along what might be wrong-headed information. So we'll watch that. Now, speaking of comments, last night I had kind of a back and forth with Ed from Canada. I'd have to go back and look. I think he said Ontario, but I don't remember. Anyway, we had a good discussion. He was taking me to task for recommending the leveraged ETFs and saying that because some fellow recommended FNGU, and I passed it along and said I thought it was good, that he thought that was irresponsible of me. And I take it, you know what, folks, I would say this. Ed and I had a good, intelligent back and forth, enough that I wanted to share it with you, and why I still think that the ETFs, the leveraged ETFs, are a good way to go, an excellent way to go. Now, I did say before that the leveraged ETFs can go down 3 times faster as well as up 3 times faster. So what's critical here, let me take myself out of here for a minute. Whoops, took out the wrong thing. What's critical here is that you kind of have an idea of where the economy overall is heading. Now, right now, and I'm taping this on the 4th of May, we're going to have some strong earnings reports. The concern that's brewing in the economy is with some of the tax proposals that the Biden administration is putting out, and with the huge spending programs that either have had already or that are also being proposed. And so people are worrying about the fear of massive inflation. We have been, for the better part of the last 4 years, in the sweet spot of an economy. We've had regulations cut. We've had the December 2017 tax cuts. If you remember, at about January of 2020, right before COVID hit, we were having the lowest unemployment on record, the lowest for African Americans, for women, for Hispanics. It was a great economy, and then COVID hit. So if we are in a period where we can have a growing economy, the leveraged ETFs are going to really exacerbate your profits. And I had this back and forth with Ed last night, going back and forth on this. And I responded to him that while I appreciated his concern, what I would say is look at this, and here is the FNGU that I had brought up about, I don't know, Thursday or so last week. This is a 2-year chart, and that you can see we've had a lot of good growth. Now, let's look at the leverage version of the NASDAQ, and that's the TQQQ. And when we look at this, we're going to see that even the leverage version of the TQQ, which was up 200% over the last 2 years, didn't come close to the FNGU. You can go back and look at that video from last week where I go into a little more detail of it. The FNGU up 461.5% over the last 2 years. Now, folks, when you engage, when you engage in these leveraged ETFs, as I say, you have to have some inkling of where the economy is headed. And right now, I think we are still generally going to be headed upwards over the better part of 2020. Where are we going to be in 2021? It's a little too early to tell because I don't know if some of these Biden taxes are going to pass. I have a feeling they're not going to. And so I think that we'll be probably okay with these leveraged ETFs. But it would be true that if you have an economy that looks to be slowing down, going towards a recession, well, then you certainly don't want to be in these leveraged ETFs. But, excuse me, if we go back to just about a year ago, here's March 16th where I've got the cursor, and back then we had the TQQ, which is the red line, was at, look at that, $17.75. Let's just call it $20, okay? By around St. Patrick's Day, by March 20 of last year, it was at $20 or so. It went up, and when we get to about March 20 of this year, just 1 year, here we go on March 29, it's at $95.90. And actually, let's just go here to March 12. So about a year later, the TQQ went up to 111. That means it was up actually, it looks like 5 times. It actually was up 10 times. Because in January of this year, 2021, in January of this year, the TQQ split 2 for 1. So if you had bought 100 shares of the TQQ back in around St. Patrick's Day of 2020, in that neighborhood at $20, it went up to $200. So you had a 10 times gain. Your $20 went to $200. And then in January of this year, it split 2 for 1. Okay, so you would have, if you would put $300 or 300 shares in back around St. Patrick's Day of last year, and I was working this out last night talking to our friend Ed in Canada who said that it was irresponsible of me for doing these leverage ETFs and telling you. I'm saying that when I worked out the numbers, this leverage ETF on the TQQQ, the leverage version of the NASDAQ 100, the 3 times, gave a return of 511%. And the way I worked it out last night, doing the numbers, was that if you had bought at $35 a share and bought 300 shares, that would have been $10,500. A year later, it would have been worth, your $10,500 would have been worth $63,000. I think it was $63,500. So, folks, that's a powerful statement, and where I am so often fighting back against the traditionalists that say these are designed for only short holdings. They may be designed that way, but they also give massive returns. $10,000 to $63,000 in 1 year. Now, that means, what is that $63,000 going to go to in the next 10 years? And I don't mean keeping it necessarily in the leveraged indexes, but the point is, if you're a middle-class family trying to gain and build your wealth, these are a powerful tool to help you do that, okay? The leveraged ETFs. And I have some other videos on this you can look at, but you have the TQQQ for the NASDAQ. You can see here the FNGU, which is a 3 times on the FANG stocks, and you have 3 times the S&P 500, which is a UPRO. And if we look at the regular S&P 500 by comparison, we see that over the last 2 years, it's only gone up 41%. I've hit on these before, but I want you to recognize that these are powerful. Yes, they go down 3 times as fast, just like they go up 3 times as fast. However, it can push you years ahead of where you would have been. What I would suggest is you don't want to put all your money in these. You want to have them as part of your portfolio, but you want to limit their position to your total portfolio to, it's up to you, maybe 10%, maybe 15%, but you can have a very powerful push. And if you get a remarkable downturn, as we did last year in COVID, that's the time, once we hit bottom and we start to come off. Don't wait till you hit the bottom and then you bounce off. Then you might start to put some money in, and you don't have to put all your money in at one time. It's always good to, filter in your money with a multitude of investments, as I have done with a Humble, where I've probably purchased it at, I don't know, maybe 15, 20 different times. You can just make your purchases over time, just in case you're wrong and it goes even further south, okay? Now, talking about Humble, we closed today, what I think it was, I don't even have it right in front of me here. Let's take a quick look. We closed at, I think, just about down 7 cents, and we are at, here we are, 136, just under 7 cents. And I know this is, as we've talked about before, very disconcerting to some, but it's been holding up. Again, we got to wait until the Friday announcement. Folks, here's something that I have said repeatedly to you. You are buying a company, you're not buying a stock price. Think about all that Humble's doing. Think about how they just added the new talent. Are they still going to be in business in July? Yes. Are they still going to be in business in September, December, April of next year? Yes, yes, yes. So what I would say is focus on the fact you're buying a business. And I found this old clip from about 30 years ago or so of Warren Buffett talking about this with Adam Smith, who had a show on PBS, I believe. Let's take a listen for about 20 seconds or so of what Warren Buffett had to say about this very topic.
Prices don't tell me anything about a business. Business business figures themselves tell me something about a business, but the price of a stock doesn't tell me anything about a business. I would rather value a stock or a business first and not even know the price, so that I'm not influenced by the price in establishing my valuation. And then look at.
So there you are. So he's talking, as you say, basically the same thing, that the stock price is meaningless in some ways to the performance of the company that you're buying. And Warren Buffett, in another more recent interview, was saying how Berkshire Hathaway, his company, had their stock go down 50% 3 different times over the last 60 years or so. Had nothing to do with the operation of the company. So when we're looking at Humble and we're looking at these prices being down as they are, much lower than what we want, just remember the stock price doesn't necessarily have anything to do with the operation of the company. It can, it doesn't necessarily. And of course, the real thing that we've got to be looking at is what's going to be said on Friday. What are we hearing about mergers? What are we hearing about new talent? What are we hearing about the NFTs and the performance of the ETFs? These are the things that will be coming up on that call, 4 p.m. Central Time, 2 p.m. Pacific. And so we hope wherever you are in the world, you'll be watching along with us. In the meantime, we'll keep looking at what the stocks are doing, what Humble's doing, any news that comes out. Just recently too, GVSI, George, Victor, Sam, Ida, you probably know, but George Sharp came out and got custody of that stock today. It's a penny stock and it shot up like about 48 cents. So if you're interested in playing that and putting any money into GVSI, maybe George will say something more about it going forward. Anyway, for now, folks, have a good night. We hope that you continue to stay positive. Don't worry too much, and we will be talking to you again tomorrow evening. Take care until then.